Global markets are in a frenzy. By now, you've probably heard about the Silicon Valley Bank collapse, the second biggest bank collapse of all time. Just days later, Signature Bank fell. And now, Credit Suisse. Left and right, we're seeing massive bank crises that are increasing in size, causing uncertainty in global financial systems. Now, the fear of a global banking crisis is at an all-time high, and analysts are warning that this level of chaos hasn't been seen since the financial crisis that spearheaded the recession of 2008. In this video, we'll break through the noise and help you to understand what led to the demise of these banks, and why the current banking landscape is at a critical point today. It all started with the news coming from Silicon Valley Bank and their mismanagement of funds. Silicon Valley Bank, or SVB, was the 16th largest bank in the United States, worth about $80 billion. The commercial bank mainly serviced venture capital funds and tech startups, as the name Silicon Valley Bank implies. Some of their clients include companies like BuzzFeed, Etsy, Roblox, and Roku. Like most banks, SVB made money by using customers' deposits to lend and invest. SVB tends to invest a lot of money in bonds and treasuries, known to be stable investments. The issue, then, was that Silicon Valley Bank was having liquidity issues and had to sell those bonds at a loss because they decreased in value. As US financial news outlets have widely covered for over a year, the Federal Reserve has been raising rates since March of 2022. When interest rates go up, the value of existing bonds goes down. Holding these bonds until they mature ensures that you will receive your expected payout. However, if you have to sell those bonds at a loss before they mature, you can lose a substantial amount of money. Such is the case for Silicon Valley Bank. While the value of their existing bonds were declining, more of the bank's clients were making withdrawals. That meant SVB had to sell those investments at a massive loss to cover the deposits, totaling a $1.8 billion loss. News of this debacle made customers nervous and fearful. Venture capital firms advised companies to withdraw their money from the bank. Thus, $42 billion was withdrawn from the bank in one day. Silicon Valley Bank ran out of money and the government shut them down. The stock plummeted over 60% on Thursday, and by Friday morning, SVB shares were halted and it had abandoned efforts to quickly raise capital or find a buyer. Several other bank stocks were temporarily halted Friday, including First Republic, PacWest Bancorp, and Signature Bank. On Sunday, the government announced that it would fully protect all deposits from Silicon Valley Bank, with an official statement coming from the Federal Deposit Insurance Corporation, or FDIC, stating that all deposits, both insured and uninsured, will be covered. Just when the crisis seemed to have been averted, Signature Bank, a New York-based regional bank with ties to real estate and cryptocurrency lending, was suddenly shut down on Sunday. This marks the third largest bank failure in US history, just 2 days after the country's second biggest failure. As the Silicon Valley Bank panic swelled, Signature Bank customers withdrew more than $10 billion in deposits. Similar to SVB, news caused a drastic and swift depletion of the bank's stock value. In 2 short days, the massive withdrawal requests had caused regulators to close the bank amid fears that the financial system could be threatened if the bank remained in operation. So far, issues in the banking industry have been limited to regional banks. That all changed on March 15th, when shares of Credit Suisse plunged as the bank disclosed problems in its financial reporting. Credit Suisse is a global investment bank founded and based in Switzerland. Boasting $569 billion in assets, Credit Suisse is one of the only 30 banks in the world listed as systematically important by the International Financial Stability Board. The Swiss bank announced that it had uncovered material weaknesses relating to its financial reporting. This, of course, caused Credit Suisse shares to plummet. Additionally, the Dow Jones Industrial Average fell by almost 1% Wednesday, and European banking stocks tumbled, contributing to a 3% fall in the Pan-European Stoxx 600 index. Compounding Credit Suisse's problems, the bank's largest investor, Saudi National Bank, signaled that it would not be providing financial assistance. Like the US government did just days prior, the Swiss National Bank, attempting to ease fears, announced that it would lend Credit Suisse the money necessary to shore up the firm. Credit Suisse has struggled with a myriad of problems throughout the years, and though its troubles differ from those that brought down Silicon Valley Bank, Credit Suisse is much larger and more integrated with the global financial system, and its problems come amid growing worries about bank stability globally. European economists note that Credit Suisse's situation is a much bigger concern for the global economy than the regional US banks that headline news in the week prior. Unlike Silicon Valley Bank, Credit Suisse is considered a global, systematically important financial institution, with more assets and vastly stricter capital requirements. Credit Suisse also has $486 billion in liabilities on their balance sheet. For context, SVB had just $195 billion in liabilities. 5-year credit default swaps for the flagship Swiss bank hit a new record high. A credit default swap is a financial swap agreement in which the seller of the swap will compensate the buyer in the event of a debt default or other credit event. Credit default swaps can be used for speculation or hedging. Credit default swaps played a role in both the 2008 Great Recession and the 2010 European sovereign debt crisis. Credit spreads, then, are telling you that there is a systematic risk in the system. Not only did credit default swaps for Credit Suisse rise, US banks' CDS prices also surged as contagion concerns widened. Spreads on 5-year credit default swaps on JP Morgan Chase, Bank of America, Morgan Stanley and Wells Fargo shot up to their highest since October, while those for Goldman Sachs and Citigroup reached their highest points since November. Credit Suisse has clearly shocked the system, with odds of a bankruptcy spiking to levels we've never seen before from almost any major bank, even in 2008 and 2009. In an earlier video, we covered the top 10 stocks for 2023 according to Wall Street analysts. That list included financial institutions like Bank of America and Charles Schwab. Given the major events that have occurred recently, regulations are likely going to get much more stringent, making banks much less profitable. Plus, we still aren't sure how the Fed will proceed and whether or not they will continue to raise rates as they have been. In fact, we likely won't have much clarity on the situation for months. So it might be best to reevaluate those positions and reserve your judgment until after the dust settles concerning global bank stability. Hopefully, you've learned a lot from this video and now understand why the markets are in such a panic. The banking crisis has massive effects worldwide, and we'll continue to monitor it as it progresses. If this information helped you, be sure to subscribe for more content like this, and we'll see you next time.